I'm going to explain the pros and cons between the major investments that entrepreneurs participate in. The first one is your own company. Your business is where you can potentially generate the highest return because you're utilizing your intellectual property, your unique skills, your time and energy. The big benefit there is you can generate a high or outsized return. The downside is you've got to invest your time into the business, and you also have a lot of downside risk, is that if you're not around, that business might not be worth as much as if you are. Next item on the diagram is private equity. Now, private equity, you can invest in diversified private equity in a lot of different companies, or in one company if you're comfortable with that level of risk. Private equity, generally speaking, should pay you, if you buy it right and you invest right, should pay you a similar return to public equity plus an illiquidity premium, meaning you're tying up your capital for a period of time, so you should, in theory, get a higher return. This is going to differ depending on what fees you're paying and how you're investing, but generally speaking, private equity might be able to be a return generator in a passive way that may be a little bit higher than what you generate in the public markets. Downside is you could lose all your capital, and there's certainly a lot of risk investing in someone else's company. The next is public equity. Public equity, aka the stock market. If you invest in the stock market, you can generate great returns in the market over the long term, but you don't have control over the investment, and there can be a lot of volatility. So the big con is you don't know on any given day what the market's going to tell you the price is. Could be high, could be low. If you look at the market over a long period of time, call it 3, 5, 7, 10 years, the market's pretty upward trending. But on any given day, it could be up or down, and that volatility can give some people some angst and make them feel uncomfortable if the market falls heavily. Next, we've got fixed income. Fixed income, pretty low risk, assuming you're buying traditional bonds, but you're not going to generate that great of a return. You might, generate a rate of return like inflation, potentially double the rate of inflation, but your money is more stable and is guaranteed by some issuing authority, whether you're buying a corporate bond or a US government bond or something of that nature. And your downside is also more limited because you have some institution guaranteeing that interest payment. Next you've got is cash or cash alternatives. Cash might be cash in the bank that might be insured, essentially having only the risk of default or having the US government backing up that risk. Or you might be looking at cash alternatives like US Treasuries, which are backed by the full faith of the US government, and those can have lower risk associated with those or no risk associated depending on how you view government-backed securities. And finally, the asset class that isn't on this chart, which is crypto. Many individuals are investing in crypto now. The reason it's not on this asset class is because it's too new and there's not really fundamentals that have been proven to back crypto. Crypto's gone up substantially since it's come out, but it doesn't have revenue or earnings or fundamentals that drive its value. So while it is an asset class that many people participate in, the jury's still out on its sustainability over the long term. Hope this is helpful in understanding the pros and cons of different investment asset classes.